From the perspective of essential versus discretionary consumption, our approach at Giaffa is quite different from other institutions. That's why we've been able to survive in this sector and develop our own unique investment logic. The core of this is that we grasp the true nature of Chinese consumption, its fundamental, underlying logic. Most of what can be explained about Chinese consumption comes down to the fact that the main market for consumption in China is driven by these basic principles. Consumers' purchasing power is focused on essential, high-frequency, livelihood-related industries. These products must offer great value for money. This is what we've observed. As mentioned, products like oil, salt, soy sauce, vinegar, and tea, these essentials are where the large markets are, and only in these sectors can great companies emerge. That's why at Jiafa, we focus on essential, high-frequency, livelihood-related sectors as fundamental infrastructure. Companies with these capabilities have many opportunities in the industry. Secondly, we want to invest in sectors with a large overall market, high consumption frequency, and high repurchase rates, products that also serve as essential infrastructure for people's livelihoods. Why do we focus on this? Because many people don't really understand. For example, the ROE indicator, which is return on equity. Many people think that the core factor in ROE is the interest rate. But that's actually not the case. In a fully competitive market environment, most industries, unless they have unique technology or exceptional capabilities like Apple or Windows or companies like Alphabet and Google, because they have technological monopolies, they can achieve high gross margins. But in a fully competitive market, in most cases, competition leads to gross margins becoming similar. That's why when we look at companies in the same industry, their gross margins are similar. So, the days of winning by having higher gross margins are over. That was the era when a bigger pond meant bigger fish. So what's the key now? The second indicator is turnover rate. Turnover rate shows company management. In the same environment, companies with higher management can achieve revenue and profit 2, 3, or even 10 times greater than yours. When it comes to companies focused on turnover, what drives it? Things like total asset turnover, net asset turnover, and inventory turnover all are related to management capabilities, how well you understand digitalization, your insight into end markets, your ability to manage channels, and how much you value customer lifetime value. Your ability in product research and development, the efficiency of your production and supply chain iteration and operations management, whether you can achieve highly efficient digital insights across the entire value chain of the company. These aspects of operational management determine what? They determine your efficiency, and that efficiency is directly reflected in your turnover rate. That's why top-tier enterprises and good companies almost always have very high turnover rates. This is reflected in ROE, where the key to success lies in achieving a high turnover rate.